16 बार इससे भी बड़े गोते स्टॉक मार्केट ने लगाए। इसको चुनाव के साथ जोड़ना नहीं चाहिए। खैर, अफवाहों के कारण ऐसा हुआ भी होगा, तो 6 जून के पहले आप बाय कर लेना, 4 जून के पहले वो शूट अप करेगा।
Hi, after seeing the market movements and all the news around it, you must be very confused. On one side, Amit Shah is saying that the markets will hit all-time high after the election results. On another side, we are seeing huge intraday volatility and India's fear index going up by 60% this month. So around 2 months ago, we had done a video on the March madness in the market. So yes, March was indeed volatile, but May is turning out to be even more crazy. With elections and its results coming out very soon, and looking at what is happening, you might see that the market is moving up, it's moving down, intraday volatility is crazy, and option buyers, option sellers, both of them are getting hit left and right. So in this video, we'll look at what is causing all of these volatility in the market currently. Is a crash going to happen? Is it the best time to buy right now? And what will be the impact of elections on the Indian markets over the next 3 to 6 months? We'll also be looking at my personal view and how I am planning to attack my trading and investment style over the coming volatile period. So welcome to another video. This is Ajay Ajith. Let's get started. So first things first, let's look at the FII data. FIIs, if you're looking into it, have sold for more than 36,000 crores as of today, the 15th of May. FIIs, or the foreign institutional investors, are the big players in the Indian cash market. They might be investment banks, they might be foreign mutual funds, they might also be foreign individual investors pooling in their money and putting or trading in the Indian market. So generally, FIIs, very important, they're foreign institutions who have the power to affect the Indian stock market. And last month, if you're looking at the entire April, they had sold around 35,000 crore rupees worth of stocks in the Indian cash market. And now by the 15th, now only halfway through the month, they've already crossed this number. So on one side, foreign institutions have been heavily selling in the Indian markets. But on the other side, we are not seeing that much crash happening, right? Nifty's correction till now has only been 2.5 to 3%. So what is happening here? DIIs, or domestic institutional investors, they are coming into play. Our mutual funds, our institutional investors, our banks, LIC, all of them are coming together and supporting the market. In fact, while the FIIs have sold more than 36,000 crores in the Indian stock market, DIIs have supported it and bought for more than 30,000 crores. But here is where things get a bit deceiving. These DII investments are nothing but our SIP investments, our monthly mutual fund investments, our LIC policies, our insurance premiums, all getting pulled in and pumped into the stock market. It does not mean that the market is strong. Once they do run out of money, if and when they do, they will no longer be able to support the market. So just because DIs are buying and supporting our markets for right now, it does not mean that the markets are performing well. Just because we are in a consolidation mood, there is a lot of back and forth, selling from here and buying from here, which is happening. For now, it is going okay. But as you know, for the market to fall and for there to be a big crash, there need not be any big trigger. 1 or 2 days of crazy movements in the market can trigger even a bigger fall. And coming into the effect of this is the India's volatility index, or India VIX. We have done a detailed video about India VIX here. You can check it out in the I button. And coming into the heavy battle going on between FIIs and DIIs, it is what is being reflected on India VIX, or India Volatility Index. And if you're looking into the VIX numbers right now, you might be seeing that India VIX is now at 20. It is at one of the highest levels since late 2022. Nearly 2 years since India VIX has been at these levels. So usually this fear index moves when such uncertain events like elections, a war, or situations like the 2020 crash come about. But this time also we were expecting a kind of okay atmosphere for the market. Everyone kind of expected what the election results were going to be, and now we are seeing a change in sentiment and the VIX shooting up since start of the election. Nearly in the last 30 days, VIX going up by more than 100%. And this is happening because of the FII DII battle that we discuss about. Retailers getting panicked, right? I'm seeing a lot of people asking this question, will a crash come? Will a crash come? And because of that, just because of that, market volatility is also increasing, and because of all the confusions that the media is creating. So in this panic situation, let us think very logically. We'll be the ones to think logically, and we'll look at the technical factors and also also the fundamental factors that could affect the stock markets over the coming short term, over the next 3 to 6 months. So since VIX is also higher, we have to look very carefully into the technicals of the market. And looking at the technicals, as of today, Nifty is trading somewhere around 22,200, which is not too far from the all-time high. It is just 2.5% down from the all-time high level. So from here, what do we understand? If you're taking a Fibonacci retracement level, that is from the recent top to the recent fall, we can understand that after the market topped out around 22,800, it had fallen because of the election and all the craziness around it, and because of Amit Shah's statements that we saw in the beginning of the video, the market is slowly trying to bounce back up. The question everyone has is this temporary reaction to all the statements that the government or ministers are trying to put out, or is this a larger recovery which is happening? Right? And we'll get into that. So for the question of is this a real bounce which is happening, we have to look at the Fibonacci retracement chart, and the levels are showing that 22,425 is going to be a very important level, which is a 0.618 level of the retracement tool. It is showing that that is the level which is required for us to confidently say that the market is going to rally up even further from here. So for all the bullish investors watching this video, that is a level to watch out for to say that Nifty is going to shoot up from here. But on the downside, we have certain risks as well. With the recent fall in the market, it has been shown that 21,800 is going to be a very decisive level, and from the level that we are now, 21,000 is going to be the next major important support. So a fall of nearly 4 to 5% can also be expected. So do remember, to buy and pump up the market, a lot of money needs to be injected into the market. But for the market to go back down, only those people who are holding the stocks currently, they just have to book profits, or some amount of panic selling has to happen. That is all the trigger that the market will need to go down. So it is always easier to come back down than to go up. Do keep that in mind. So we have looked at the technicals. The recent low of 21,900 to 21,800 is going to be super important for the market, and after that, the previous all-time high of around 21,000 is going to be important, which is around 5% further down from here. And on the upper side, 22,420 with a possible all-time high hitting if that level is crossed. That is where the market is at right now, and I feel that it is in a confused state, not wanting to move up, either up or down, and we shall be seeing a big reaction after this consolidation phase. So what should you do now? FIAs are selling heavily in the market. The price action doesn't look too strong. In fact, it looks weak, with this being a possible dead cat bounce from the recent fall that we have seen. And we are also seeing that most of our portfolios are also in the red. So as always, let us break this down into multiple segments. If you're an SIP investor, I would suggest that you do not stop your SIP. In fact, in such a time like this, it is very important when there is an uncertainty in the market for you to continue your SIP. I've done a detailed video on SIP versus lump sum. I'll link it here in the I button, where I talk about how it is important to stay invested in the market for the long term based on any other assumption. If you try to time the market, you will only end up being in the losing side of history. So what is the benefit of continuing your SIP here? If the market moves down, your monthly SIP amount, it will contribute to you buying more mutual fund units. And if the market is going up from here, then all well and good. You do not have to be concerned, and you can continue to enjoy the profits that you're making on your portfolio. And if you're already heavily invested into the market for the last multiple years and you're holding that portfolio, I would say just keep on holding it. Keep on adding monthly as you are doing today. Do not make any change in the current market situation. Again, this is based on my understanding of the market. I'm not a SEBI-registered research analyst or a financial advisor. Do make sure you do your own studies before you invest and trade with your hard-earned money. So the second segment is those who are going to be investing lump sum into the market. Maybe you saw Amit Shah's statement that the market is going to rally up from here and you're going to invest all of your money lump sum into the market. But I would say hold on to that thought. Now is not the right time to start experimenting with your money, considering that elections are a hugely volatile time. It is not going to be a win-win situation. I would say lump sum investors can hold on to their investments, and as we have said in that video, SIP versus lump sum video, you can even think about breaking down your lump sum investment into multiple monthly SIPs. if you're holding considerable assets and you're worried about a big crash happening in the market, I would suggest you to even look into hedging based on your current portfolio size. You can look at certain put options in the market which could give you the hedging or the protection that the options instrument is supposed to give you. You can look into put options from the mid of June to the end of June from those series, and you can think about hedging your portfolio. Just buying a hedge in a Nifty put option would be ideal for you. Again, do not get too much over invested into this. If your portfolio is worth let's say 5 to 10 lakhs, based on that amount, you can take a put option. I'll show the calculation here. That is how you'll need to buy a put option. So if the market falls, you'll be making some profits on the put option and it will be acting as an insurance on your current holdings. That is what a put option ideally is supposed to do. So if you're a trader in the market, in fact, if you're a good trader in the market, I would say look for opportunities, because with the current market situation right now, long Vega strategies which work really well when the market volatility is increasing would be beneficial for you. One type of this is calendar spread. Another type of strategies that you can explore are ratio spreads. And this is what will work now for the upcoming 3 to 4 weeks. When the market volatility is really high, you can deploy these strategies. If you're an option seller, these are the strategies that you can deploy. Even if you're an option buyer, you can think about reducing your position sizing, because the expectation is that you'll be able to make a lot of profits when the market is volatile, right? But the thing that you have to note as an option buyer is that you have to limit your losses. So option sellers, you can shift to different types of strategies, especially these long Vega strategies. Option buyers, you can think about reducing your position sizing, reducing your capital per trade, so that even when you do make losses, which can happen in markets like this, you do not end up with heavy hits in your portfolio. And later, when the market cools down, you can come back or shift back to your regular strategies, which can either be credit spreads, your iron condors, or your non-directional, any sort of strategies. These would start giving you more profits when the market volatility starts crashing back. And if you're asking my opinion or what I think of the current market situation, I think that all of which the market is doing right now is very, very temporary. Right after the elections, I'm expecting the market to move back up to all-time highs and keep on moving up from there, because the global markets are doing well. FIAs will return no matter which government comes into power. We have seen that over the last 20 years of data. In fact, I'll show a table here which says that no matter which government comes, BJP or Congress, the market has done spectacularly well. But at the same time, I understand that even though the market volatility will keep on reducing after the elections, right now is a volatile time, and I'll be using whatever we had discussed for traders and investors as my personal application, right? I would not be going highly bullish on my view and looking to take a stupid decision. In fact, that is what I also want to tell you. What we are seeing now is volatility that you will be seeing only once every 5 years, especially Indian general elections come only once every 5 years. Why do you need to go super bullish or have a very strong view of the market now? You could have had that 2 months ago. You could have that 2 months later. You have no obligation to have a strong view now. It is okay to even take a step back, continue what you're doing with your SIPs, not do any trades or even scale back your trades. That is also fine. That is my personal view. In fact, you can choose to not have any view at all. You can choose not to run your discretionary strategies right now. Even if you're running any discretionary strategies, you can run them at a lower capital if you're not experienced. If you're doing a system-based trading, you can let that continue while also continuing your regular investments into the market through the SIP route. So that's it for the video, guys. This is Ajay Ajith signing off. See you in the next video. Bye bye.